Welcome students to Finance and Module 1. In this module we are going to introduce firms and see what their objectives are from the perspective of corporate finance. This will provide an overall objective that will help guide our study through the modules that follow. Unlike many other functions in firms, such as marketing or management, we will see that this objective is very simple. It is also one that has stood the test of time for many decades and across the world. But because it is so simple, we will see that in a real-world scenario, it starts to become an increasingly complicated objective that needs adjustment to make allowance for the environment in which the firm operates and the stakeholders that have an interest in the firm. How does corporate finance fit in businesses? If we look at Apple, the company achieved great success with their products, posting billions in revenues and profits. However, behind that success, there were financial managers, analysts, risk assessors, and a whole team of people that played a crucial part in achieving that success. For example, before the iPad was launched, there was an evaluation of the potential market for such a device. An estimation was made on how much it would cost to produce an iPad, and based on that cost, an analysis was made on how many iPads would have to be sold to earn a profit. Furthermore, contingency plans were made on how to deal with potential risks of selling the product in other countries, things like political, country, and foreign exchange risk. So in this course, we look at how financial managers deal with most of these issues. In this course, we mostly talk about firms as private sector organizations. There are different advantages and disadvantages for these different types of organization, but generally we find that businesses progress through these forms as they become larger and more complex. For example, most startups and small businesses are sole proprietorships or partnerships. For such a business, the biggest advantage is that it's easier to start. It doesn't have to comply with a lot of government regulation and various specific laws. And for a sole proprietorship, the owner keeps all the profits. The disadvantage is that the business has limited life and the owners have unlimited liability. If something happens and the owners get sued, they are liable not only with the business assets, but personal assets as well, their house, car, personal bank account. With a partnership, the advantage is that there are more owners, therefore there is more capital invested. However, like the sole proprietorship, a major disadvantage is that the partners have unlimited liability. Also, it is very difficult to transfer ownership. If one partner wants to leave the business, the partnership must be dissolved first, must sell their share to the remaining partners, then everything starts again with the remaining partners. Limited partnerships are organizations where some partners have limited liabilities. In general, these partners don't get involved in the running of the day-to-day business. They are passive partners. They only contribute capital. And because of this limited liability, they get less shares in the profits. However, their benefit is that their income is taxed as partnership income. As firms grow into medium-sized businesses, they may adopt a company form, while the very largest may eventually become publicly listed companies. A proprietary limited company has between 2 and 5 shareholders. In general, these are private companies. They still must adhere to the corporation law, and they are subject to compliance and administrative costs, which can be high. For this reason, this form of business is better suited to medium-sized businesses. And then we have the company, a legal entity owned by shareholders who have limited liability. The company has the advantage of unlimited life, easy access to capital, and business diversification. Currently, there are about 2.5 million business organizations in Australia, ranging in size from small businesses owned, managed, and operated by a single individual, all the way up to large listed companies with thousands of employees and shareholders. In addition to private sector, we also have the government or public sector, which contains many organizations including federal, state, and local government departments and agencies. A residual group is the not-for-profit sector, consisting of about 600,000 organizations. These are entities established for a community purpose and do not operate in the market sector, and only a small number rely on government for funding. Importantly, while these organizations are very different to firms, many of the tools we will learn about in this course that apply to firms, they have been equally applied to not-for-profit and government decision-making. A convenient way to introduce ourselves to the financial decisions a firm makes is the balance sheet. The assets of the firm are on the left-hand side of the balance sheet. These assets are current, short-term, and non-current, which are long-term or fixed. Some non-current assets are tangible, such as machinery and equipment. Others are intangible, such as patents and trademarks. Current assets comprise assets like inventory, cash, and accounts receivable. For example, the products made by the firm but are not yet sold are part of its inventory. Generally speaking, the non-current assets are used to produce some good or service which is intended to be sold to generate revenue. The current assets are generated as part of this productive process, as raw materials, products, services for customers, etc. In finance, we refer to the decisions we make concerning non-current or productive assets as the investment decision. However, before a firm can invest in any asset, it must obtain financing, must raise the money to pay for these assets. The forms of financing are represented on the right-hand side of the balance sheet. Typically, a firm will raise funds through debt and equity. Debt is a liability to the firm, and it can be current with repayments or maturity of less than 1 year, and is considered a short-term debt, such as line of credit, overdraft, or accounts payable, or it can be non-current with a maturity or term greater than 1 year. We consider that long-term debt, such as bank loans, capital leases, and bonds. The other form of funding is equity. Equity is created with a firm and increases as new investors invest capital into the company and become shareholders. We refer to the decisions we make concerning debt and equity as the financing decision. Finally, the firm needs to make decisions about how it will return the value created to its shareholders. We refer to this as the dividend decision. So the key 3 decisions addressed in this course are an investment decision, and we use the term capital budgeting or project evaluation to describe the process of making and managing expenditures on long-lived assets. The second is the financing decision, or how can the firm raise cash for required capital expenditure. The answer to this involves the firm's capital structure, which represents the proportions of the firm's financing from current and long-term debt and equity. And the third is the dividend decision. How should a firm reward its owners? The decision whether to pay dividends or reinvest the cash into the firm is a trade-off, because the more funds are invested back in the firm, the more beneficial it will be for the shareholders in the long run. We use the concept of dividend policy to describe these questions of whether, how, and when to return cash. For convenience, we discuss these separately throughout the course, but we will soon realize they are interrelated and that a decision in one area may affect those in other areas. Regarding the investment decision, which falls under capital budgeting, Managers must be aware of certain features of the actual cash flows before deciding which assets to buy, which projects to take on, which expenditure to budget, and so on. These issues relating to cash flows involves evaluating the size, the timing, and risk of future cash flows. The size relates to how we measure the cash flows. Accounting income does not mean cash flow. For example, a sale and the cost are recorded at the time of sale and when the cost is incurred, not when the cash is exchanged. This means that what's in the books is not actually cash in hand. Timing refers to when the cash is received. $1 today is worth more than $1 at some future date. And we will see that there is a trade-off between the size of an investment's cash flow and when the cash flow is received. Risk refers to the role of the financial manager in dealing with the uncertainty associated with investment decisions. Assessing the risk of expected future cash flows is critical to investment decisions. Are the projected cash flows optimistic or pessimistic? Is there a risk that the assets will stop earning money? When dealing with the capital structure of the firm, managers must decide how to finance the assets. Is it raise all equity or a mixture of debt and equity? And if debt is involved, again, what is the best way to borrow money? Is it issue bonds to investors or go to the bank and borrow? The ultimate question is, what is the cheapest way to have debt in the firm? The managers must also deal with issues affecting the current assets and liabilities of the firm, items that have the most influence on the flow of cash. This is known as working capital management. Examples of working capital management decisions are who to sell on credit, how much inventory to carry, when to pay the suppliers, in summary, management of short-term financing needs. As we've said previously, the dividend decision is important as well, as it can influence the growth of the firm if management decides against paying dividends. Factors that need to be taken in consideration are any potential growth opportunities. Are there any new profitable projects to invest in that will make our firm better? So instead of paying dividends, it might be better to invest in other assets. The other issue is taxation. Are the dividends franked or unfranked? Will shareholders pay tax to get a credit for the tax already paid by the company? And last, the shareholders' preferences with respect of the structure of the dividend policy. For example, does the company have a dividend reinvestment plan? We will discuss this in our very last module in the course. In addition to the three main functions discussed, we add two more functions that are important in the running of the business. One of them is the risk management function, which involves identifying, measuring, and managing the firm's exposure to all types of risk. Examples of such risks are losses associated with fire damages, product liability, and loss associated with adverse changes in the interest rates, commodity prices, and currency values. The other is the corporate governance function, which involves developing company structures and incentives that promote ethical behavior and decision-making that benefit not only the shareholders, but other stakeholders as well. We will talk about this in later slides. Based on the corporate finance functions, we need to decide upon the firm's overriding objective. A good starting point is to think who benefits from the value of the firm. Remember that under the balance sheet identity, growth in asset value on the left-hand side will be matched by growth in the value of debt and equity in the right-hand side. Obviously, the providers of capital to the firm are the shareholders who own the firm and the debt holders who have lent money to the firm. Debt holders lend capital to the firm, and in return they expect payment of interest and repayment of principal upon maturity. While they generally have little say in the day-to-day running of the firm, they do have priority on the firm's cash flows and assets in the event of liquidation. However, these claims are fixed in the sense that they do not grow with the firm. On the other hand, equity holders invest capital in the firm to become shareholders and receive returns on their investments only after creditors are paid in full. Unlike the debt holders, the shareholders' claims to firm value is not fixed and have an unlimited upside. Let's suppose the market value of a firm is measured by its assets and is. What is the conclusion we draw then? Shareholders are better off in terms of wealth as measured by the value of shares they hold if the value of the firm as a whole increases. So managers should maximize the value of the firm. In our example, the value of shares matches the value of the firm. This will only happen if markets are fully efficient. That is, the true value of the firm is the same as the market's assessment of the value of the firm. Debt reduces shareholders' wealth because equity holders only have a residual claim on the firm's assets. Accordingly, shareholders will only benefit from the use of debt if it increases the value of the firm. The implication is that managers should only issue debt if the firm increases firm value. So what should be the objective or the goal of the financial manager? Is it survival? Is it avoid financial distress? Or is it beat the competition? Or is it maximizing profits or minimizing costs? If the goal is to minimize costs, then the firm can minimize costs today by not purchasing new equipment or delaying maintenance, but this may not be in the best interest of the firm or its owners. Or if the goal is it to maximize profit, should the firm concentrate on long-term or short-term profits? Is it accounting profits or some measure of cash flow? And here we differentiate between maximizing profits and maximizing wealth. Wealth is maximized when share value is maximized. This is related to the size, timing, and risk of the firm's future cash flows. Profit maximization ignores these three items. Most of these goals present problems as they are either associated with increasing profitability or reducing risk. They are not bad, but they are intermediate objective functions. They may assist us in increasing firm value, but they are not the final objective. If they are correlated with the long-term value of the company, they work well. If they do not, the firm can end up in bad shape. Therefore, the goal of the corporation should be to maximize the shareholders' wealth as measured by the market price of a company's shares. A company's share price reflects the timing, magnitude, and the risk of the cash flows that investors expect a company to generate over time. There is no conflict about the short run versus long run here. The purpose of a business should be to make money for its owners. Maximizing the current share price translates to more money for the owners. If the firm does not have publicly traded shares, then the goal should be to maximize the owner's equity of the firm. Non-profit organizations can also follow the same principle, but their owners are the community or the people they were created to help. Does it mean that we should do anything and everything to maximize owners' wealth? This is where ethics comes into place. Some people might say that as long as share value is maximized, It doesn't matter that the product your company is selling is made in the third world country by children working 12 hours a day for a few cents. I think it all comes down to choice. Do you want to own shares in such companies? Do you want to be the financial manager in charge when you have to deal with issues like this? This is a huge conflict for the financial manager and not an easy one to answer. In our simple firm model, the parties most obviously interested in the behavior of the firm are shareholders and debt holders. In reality, there are many stakeholders in the firm. These include employees, customers, suppliers, the government, the communities in which the companies operate, environmental groups, etc. Given it is unlikely that their interests will align, firms must manage these stakeholders group within the primary goal of maximizing shareholders' wealth. Managers may care what the interests of these groups are to the extent that their actions may affect firm maximization value. In the next section, we look at how conflicts are managed in theory and in practice between several of these stakeholders: shareholders, debt holders, managers, financial markets, and society as a whole. So this is the big picture. Shareholders hire the managers through the board decisions and annual meetings, and in turn, managers have the duty of maximizing the shareholders' wealth. Bondholders or debt holders lend capital to the firm, and in turn, managers or the firm must protect their interests by ensuring they receive their money back. Financial markets are supposed to be efficient and are supposed to value assets and firms correctly at their proper value, and in turn, managers must reveal information honestly and on time to enable the valuation process. And society should be able to trace costs, if any, easily back to the firm. However, the firms should not bear any cost to the society. In reality, however, things are different. Shareholders have little control over managers, and most of the time managers don't act in the best interests of the shareholders. When bondholders lend to the firm, there is a chance that they will lose their capital if the firm goes insolvent, and in the end they will not get their money back. Markets can make mistakes by incorrectly valuing a firm's assets, and because investors are irrational, markets can overreact to certain events. In turn, managers delay bad news and sometimes even release misleading information about the company. Some firms can produce significant costs to the society, and in turn society is sometimes helpless as it cannot trace those costs to the specific firms who make those costs. So now we take each type of stakeholder in turn and analyze them more carefully. So we look first at the shareholders and the firm. Firms are characterized by what we call principal-agent conflicts, corresponding here to the shareholder-manager relationship. This arises from the separation of ownership and control, where the providers of capital pass the day-to-day management of the firm to expert managers. In theory, the shareholders should exert significant control over management through the market for corporate control, which disciplines managers to achieve shareholders' interests, or otherwise they risk their position through hostile takeovers of an underperforming firm. Therefore, they will lose their job. Also, through the market for managerial talent, which involves incentive compensations in the form of stock options and performance-related pay. And they can control the managers by actively monitoring them through the firm's board of directors and the firm's annual meetings, but also through institutional and block shareholders, and indirectly through banks and other debt holders. In practice, however, none of these mechanisms are as effective in disciplining management as theory suggests. When managers don't act in the best interest of shareholders, the firm incurs agency costs. These are some examples of agency costs. Things like excessive consumptions of perquisites, earnings manipulations, excessive diversification, or issuing less debt than optimal. Such behavior may or may not be illegal, but it is rational. Like all of us, managers are self-interest individuals that make decisions for their own benefit sometimes. Ultimately, how shareholders and other stakeholders control or try to control management is complex and relates to broader issues of corporate governance. For example, in the Anglo-American model, dominant mostly in the US, UK, and Australia, corporate governance emphasizes a well-developed and regulated stock market, strong investor protection, and substantial disclosure and reporting. In contrast, the German-Japan model, prevalent in Germany and continental Europe, Japan and other parts of Asia, assigns a greater role to long-term manager-investor and firm-bank relationships, concentrated ownership, and cross-shareholdings among firms and between firms and financial institutions. Yet, in other countries like China, shareholders provide capital but may have little control on the management action. Now let's look at bondholders and the firm relationship. In theory, there is no conflict of interest between shareholders or the firm and bondholders. There is an incentive for the firm to appropriate wealth from bondholders, but not to the extent that it would reduce the value of the firm. In practice, shareholders and bondholders have different objectives regarding the firm. Bondholders are concerned most about safety and avoiding risk and ensuring that they get their money back. They do not benefit if the firm significantly increases its value because their claims are fixed, do not change. On the other hand, shareholders are more likely to think about upside potential. It is only when the value of the assets exceeds the value of the liabilities do they obtain value. As the firm is owned by shareholders, management and the board are acting in shareholders' interest if they attempt to benefit from the expense of debt holders. They are just doing their job. Examples of such actions are when managers increase dividends significantly. When firm pay cash out as dividend, lenders to the firm are worried because the firm becomes riskier without enough cash to pay debt obligations. Taking riskier projects than those agreed to at the beginning of the contract. Lenders base interest rates on their perceptions of how risky a firm's investments are. If stockholders then take on riskier investments, lenders will be hurt because they haven't incorporated a sufficiently high level of risk in their decisions about lending money to the firm. And also through excessive borrowing, meaning that cash flow needed to service the debt or assets to cover the debt in event of liquidation may be insufficient. Because debt holders have no say in the day-to-day running of the firm, they attempt to control this behavior early by using covenants and other controls set in place before financing. Now let's look at the financial markets and the firm. In theory, financial markets are efficient. Managers convey information honestly and in a timely manner to financial markets, and financial markets make rational judgments of the effects of this information on the true value of the firm. As a consequence, a company that invests in good long-term projects will be rewarded if the markets are efficient. Short-term creative accounting will not lead to an increase in market value. And stock price performance will be a good measure of company performance. However, in practice, markets are not fully efficient. This is because the market doesn't always get it right. The information, especially negative information, is sometimes blocked or delayed by managers seeking a better time to release it. In some cases, firms release intentionally misleading information about their current conditions and future prospects to the markets. In reality, prices are much more volatile than justified by the underlying fundamentals. And financial markets overreact to news, both good and bad. Also, they are manipulated by insiders in such a way that ultimately prices do not have any relationship to the value. And markets are also short-sighted and do not consider the long-term implications of actions taken by the firm. And lastly, we look at the society and the firm. In theory, all costs and benefits associated with a firm's decisions can be traced back to the firm. Firms typically internalize these costs or benefit in the firm so that it is accounted for through taxes and subsidies. However, in practice, financial decisions can create social costs and benefits, which we call them externalities. Examples of such social costs are environmental costs like pollution, health costs, and quality of life costs like traffic, housing, and safety costs. On the other hand, examples of social benefits are creating employment opportunities, supporting infrastructure development, and creating access to goods in areas where such access does not exist. Unfortunately, social costs and benefits are difficult to quantify because they might not be known at the time of the decision. In other words, a firm may think that it is delivering a good product that enhances society at the time the product is launched, but discover afterwards that these products are making a very large cost to the society. Think about asbestos, tobacco and alcohol, and very many others. Also, costs are difficult to quantify because they are person-specific. That is, the decision makers weigh them differently. So to recap, the traditional corporate finance theory breaks down where there is a conflict of interest between managers and shareholders, when the lenders are not protected and are taken advantage of, and when financial markets are inefficient, and when significant social costs are created that cannot be traced to the firm. The solution then becomes to find a different mechanism for corporate governance, perhaps adopt certain policy that ensures ethical behavior and less agency costs. Also, to find a different objective to the firm, one that reduces the potential conflict between the firm and its stakeholders. The shareholders have provided a counter-reaction. Institutional investors have become much more active in monitoring companies that they invest in, and nowadays are demanding changes in the way in which business is done. At annual meetings, shareholders have taken to expressing their displeasure with the current management by voting against their compensation contracts or their board of directors. Since the global financial crisis, firms have been subject to strict regulations on executive remuneration. However, you cannot legislate good corporate governance in the end, and sometimes the costs of meeting legal requirements exceed the benefits. In general, laws tend to penalize good companies more than they punish the bad companies. In the context of our discussion, Managers taking advantage of shareholders has led to a much more active market for corporate control. For example, if they don't perform, the managers will be put on notice. The shareholders taking advantage of bondholders has led to bondholders better protecting themselves at the time of the issue. Firms revealing incorrect or delayed information to markets has led to markets becoming more skeptical and punitive. As investors' access to information improve, it is becoming much more difficult for firms to control when and how information gets out to the markets. When firms mislead the markets, the punishment is not only quick but is savage. While firms creating social costs has led to more regulation, as well as investor and customer backlashes. If firms consistently create larger social costs, the government response will be to pass more laws and regulations against such behavior. Finally, investors may choose not to invest in companies that they view as socially irresponsible. This is some evidence of how stakeholders affect a firm's objective. For example, in the banking industry, there are some benefits, such as innovative low-cost financial products and services, efficient and technologically advanced, well-performing sector, which is heavily regulated. However, there are some costs too, whether they are real or perceived, such as being criticized when raising mortgage rates excessively, being profit-focused and insensitive to customers, condemned for closing branches and charging high fees, and considered to be a male-dominated employment environment. This is an example of how one bank has responded to corporate governance issues. ANZ has consulted with their stakeholders and acknowledged their role in the society and community, and focusing on responsible practices, education, helping low-income families, provide banking in rural areas, and engage in sustainable practices. In their annual report, they present non-financial performance that refer to corporate governance, such as customer satisfaction, women in management, investment in the community, and again, sustainable practices. In a different sector like mining, the benefits are in the form of being a major export earner and employer, contributor to the public revenue through taxes, and sponsorship of community events. The costs are in the form of pollution, infrastructure pressure, inflationary influences on economy, working with corrupt governments and countries with poor human rights records. And this is BHP's response to all those issues. By following these principles, they are committed to address the issues of human rights, labor, environment, and anti-corruption, as well as ethical and sustainable practices, community-focused activities, and engage in transparent communication and reporting with its shareholders. This concludes Module 1.